Personal finance is a vital aspect of our lives that encompasses the management of our financial resources, including income, expenses, savings, and investments. It is crucial to have a solid understanding of personal finance principles to make informed decisions that can lead to financial security and long-term success. This video serves as a comprehensive introduction to personal finance, providing valuable insights and practical tips to help individuals navigate their financial journey. Setting financial goals. The first step in personal finance is setting clear financial goals. By defining your objectives, whether short-term or long-term, you can establish a roadmap for your financial success. Examples of financial goals include saving for emergencies, paying off debt, buying a home, planning for retirement, or funding your children's education. Clearly defining your goals allows you to align your financial decisions and actions accordingly. Budgeting. Budgeting is a fundamental aspect of personal finance that involves tracking your income and expenses. It helps you understand where your money is coming from and where it's going. Start by creating a budget that includes your income sources and categorizes your expenses, such as housing, transportation, groceries, utilities, entertainment, and savings. Monitoring your budget regularly enables you to identify areas where you can cut expenses and allocate more towards savings or debt repayment. Emergency fund. Establishing an emergency fund is an essential component of personal finance. An emergency fund acts as a financial safety net, providing a cushion to cover unexpected expenses or income disruptions. Aim to save 3 to 6 months' worth of living expenses in a separate savings account. Having an emergency fund prevents you from relying on credit cards or loans during challenging times and helps maintain financial stability. Managing debt. Managing debt is a critical aspect of personal finance. Start by understanding the types of debt you have, such as credit card debt, student loans, or mortgages. Develop a strategy to pay off high-interest debt first, as it can save you money in the long run. Consider debt consolidation or refinancing options if it aligns with your financial goals. Focus on making consistent payments and avoid taking on unnecessary debt. Saving and investing. Saving and investing play a crucial role in building wealth and achieving long-term financial goals. Start by saving a portion of your income regularly. Automating your savings can make it easier to stay consistent. Explore different investment options, such as retirement accounts, individual retirement accounts, mutual funds, or stocks. Consider your risk tolerance, time horizon, and seek professional advice if needed. Insurance and protection. Insurance is a vital component of personal finance, providing protection against unforeseen circumstances. Evaluate your insurance needs, including health insurance, life insurance, disability insurance, and property insurance. Ensure you have adequate coverage to protect yourself and your loved ones from potential financial risks. Building credit. A good credit history is essential for various financial transactions, including obtaining loans, renting an apartment, or even securing employment. Building and maintaining good credit involve paying bills on time, keeping credit utilization low, and avoiding unnecessary debt. Regularly monitor your credit reports and correct any errors promptly. Retirement planning. Planning for retirement is a significant aspect of personal finance. Start early and contribute to retirement accounts or individual retirement accounts, IRAs. Take advantage of employer matching contributions if available. Consider consulting a financial advisor to help determine the appropriate retirement savings strategy based on your goals and risk tolerance. Developing a solid foundation in personal finance is essential for achieving financial security and meeting your long-term goals. By setting financial goals, budgeting, managing debt, saving, investing wisely, protecting yourself with insurance, and planning for retirement, you can take control of your finances and build a brighter financial future. Remember that personal finance is a lifelong journey, and continuous learning and adaptation are key to financial success. Start implementing these principles today, and watch your financial well-being grow over time.
While the notion of leveraging debt might seem counterintuitive at first, the financial world is full of strategies where judicious use of borrowed capital can pave the way for wealth creation. In this video, we're going to explore unconventional yet legitimate ways individuals and businesses can turn debt into a powerful tool for financial success. So, buckle up as we delve into the art of making money with debt and discover the potential that lies beyond conventional financial wisdom. Making money with debt involves strategic and informed decisions that can help leverage borrowed capital to generate returns. Investing. Consider using borrowed money to invest in assets that have the potential to generate a higher return than the cost of the borrowed funds. This could include stocks, bonds, real estate, or other investment vehicles. Real estate ventures. Leverage debt to invest in real estate, such as buying rental properties or engaging in house flipping. The appreciation of property values and rental income can potentially outweigh the interest paid on the borrowed money. Business expansion. If you own a business, strategically using debt for expansion can lead to increased revenue and profitability. This might involve investing in new equipment, expanding facilities, or launching new products or services. Entrepreneurial ventures. Use debt to fund entrepreneurial ventures. Many successful entrepreneurs have started businesses with borrowed capital, and if the venture succeeds, the returns can far exceed the initial debt. Stock market margin trading. Engage in margin trading in the stock market. This involves borrowing funds to buy stocks with the expectation that the returns will be higher than the interest paid on the borrowed money. Education and skill development. Invest in education or skill development using loans. Acquiring new skills or furthering your education can enhance your earning potential in the long run, potentially justifying the debt incurred. Arbitrage opportunities. Identify and take advantage of arbitrage opportunities where the cost of borrowed funds is lower than the return on the investment. This could include currency trading, interest rate differentials, or other market inefficiencies. Debt refinancing. Refinance high-interest debt with lower interest options. This can free up cash flow and potentially save money in the long term, allowing you to allocate funds more strategically. Leveraging debt to build wealth requires a careful and strategic approach. Strategic investments. Identify investment opportunities that have the potential to generate returns exceeding the cost of borrowing. This could include stocks, mutual funds, real estate, or other assets. Diversify your investments to mitigate risks and maximize potential gains. Real estate leveraging. Utilize debt to invest in real estate, but go beyond traditional property purchases. Explore strategies like real estate partnerships, where multiple investors pool resources to acquire larger properties, spreading both the risk and the potential returns. Entrepreneurial ventures with scale. Leverage debt for entrepreneurial endeavors that have the potential for significant scale. Consider business models that can quickly capture market share or disrupt industries, allowing you to repay debt and accumulate wealth more rapidly. Acquire cash-flowing assets. Focus on acquiring assets that generate consistent cash flow. This could include dividend-paying stocks, rental properties, or businesses with reliable revenue streams. The steady income can help service the debt and contribute to long-term wealth accumulation. Education for high-income skills. Invest in education to acquire high-income skills. This might involve taking courses, attending workshops, or pursuing advanced degrees in fields with high earning potential. The increased earning capacity can justify the initial debt incurred for education. Business expansion and innovation. If you own a business, leverage debt for strategic expansion and innovation. This might involve investing in technology, marketing, or research and development to stay competitive and increase the value of your enterprise. Explore private equity and venture capital. Consider investing in private equity or venture capital opportunities. These investments often require a higher level of risk tolerance but can offer substantial returns. Evaluate opportunities to participate in funding early-stage companies with significant growth potential. Tax-efficient debt structures. Work with financial professionals to explore tax-efficient debt structures. This may involve taking advantage of tax-deductible interest or using debt in a way that optimizes your overall tax position, enhancing your ability to build wealth. Debt recycling. Implement a debt recycling strategy where you consistently refinance existing debts to take advantage of lower interest rates or to redirect funds into new investments. Debt consolidation. Consolidate high-interest debts into a single, lower-interest loan. This not only simplifies repayment but also reduces the overall interest burden, potentially freeing up cash flow for other investments or savings. Peer-to-peer lending platforms. Explore peer-to-peer lending platforms to borrow directly from individuals or groups. These platforms often offer competitive interest rates and can be an alternative to traditional banking channels. Employee stock ownership plans, ESOPs, for businesses. Consider implementing employee stock ownership plans. Employees become partial owners through these plans, and the company can use debt to fund the purchase of shares. This aligns the interests of employees with the success of the business. Equipment financing. Businesses can leverage debt to acquire necessary equipment. This allows companies to invest in technology or machinery that can enhance productivity and competitiveness, ultimately contributing to financial success. Franchise financing. Individuals interested in starting a business can explore franchise financing. Many franchises offer financing options, allowing individuals to use debt to enter a proven business model with established support and brand recognition. Government grants and subsidies. Investigate government grants and subsidies that may be available for businesses. These funds can act as a form of debt that doesn't necessarily need to be repaid, providing a financial boost for growth and development. Credit lines for short-term needs. Businesses can establish credit lines to address short-term cash flow needs. This allows for flexibility in managing operational expenses and taking advantage of opportunities without resorting to long-term, high-interest debt. Invoice financing. For businesses with outstanding invoices, consider invoice financing. This involves borrowing money against unpaid invoices, providing immediate cash flow while waiting for customers to settle their bills. Strategic partnerships and joint ventures. Explore strategic partnerships or joint ventures where resources are shared. By collaborating with other businesses or individuals, you can pool funds and expertise, reducing the need for excessive debt while still achieving financial goals. Subscription-based models. Businesses can transition to subscription-based revenue models. This predictable income stream can provide a stable foundation for servicing debt and planning for future investments. Contrary to the common perception that debt is purely a financial burden, strategic utilization can transform it into a potent instrument for wealth creation. Financial intelligence. Develop a keen sense of financial intelligence. Understand not only the cost of debt but also the broader financial landscape. Velocity of money. Embrace the concept of the velocity of money. Use debt to circulate funds efficiently, ensuring that borrowed capital generates returns at a faster rate than the interest accrued. This accelerates wealth accumulation and compounds financial growth. Behavioral economics. Acknowledge the psychological aspects of financial decision-making. Be aware of behavioral economics principles, such as loss aversion and cognitive biases, to navigate the emotional challenges associated with managing debt effectively. Creative financing structures. Explore innovative financing structures. Consider convertible debt, profit-sharing agreements, or other non-traditional arrangements that align the interests of lenders and borrowers in unique ways, fostering mutually beneficial financial outcomes. Timing and economic cycles. Recognize the cyclical nature of economies. The art lies in leveraging debt during opportune times, such as economic upswings, to amplify returns. Conversely, adopting a conservative approach during downturns can safeguard against undue risks. Technological integration. Embrace technological advancements to optimize financial strategies. Utilize fintech tools for real-time analytics, automated budgeting, and investment tracking to enhance decision-making precision and adaptability in the fast-paced financial landscape. Environmental, social, and governance (ESG) considerations. Integrate ESG factors into financial decisions. A conscientious approach to debt can involve investments that align with sustainable and ethical practices, contributing not only to financial success but also to positive societal and environmental impacts. Dynamic risk management. Implement a dynamic risk management approach. Continuously reassess risk tolerance, adjust debt structures based on market conditions, and diversify investments strategically to navigate uncertainties and enhance the overall resilience of financial portfolios. Cross-asset strategies. Engage in cross-asset strategies that involve diversifying debt across different investment classes. This approach can mitigate risks and capture opportunities in various markets, optimizing the overall risk-return profile. Continuous learning. Cultivate a mindset of continuous learning. Stay curious about evolving financial instruments, market dynamics, and emerging trends. Making money with debt is an ongoing journey that requires adaptability and a commitment to staying ahead of the curve. In mastering the art of making money with debt, individuals and businesses must blend financial acumen with creativity, adaptability, and a deep understanding of the ever-changing economic landscape. By doing so, debt can become a canvas upon which the brushstrokes of financial success are painted with precision and artistry. As we conclude our exploration into the intriguing world of making money with debt, remember that financial strategies always come with risks and responsibilities. The key is not to shy away from debt, but rather to master the art of leveraging it wisely. Whether you're an investor, entrepreneur, or someone simply looking to enhance your financial acumen, understanding how to make money with debt can open up new doors of opportunity. Always conduct thorough research, seek professional advice, and make informed decisions to harness the power of debt as a tool for wealth creation. Thank you for joining us on this financial journey, and until next time, may your investments be wise and your debt strategic.